All right, let's start with Janet Yellen. What does the Greek crisis do to any decision about interest rates in the United States?
Well, the U.S. is fairly insulated from these events. Now, this is assuming that there's some sort of compromise that Greece actually stays in. If there's a Grexit and that leads to some destabilization in financial markets, then obviously the risk of transatlantic contagion is higher and could, all else being equal, lead the Fed to a pause. But as Olivia highlighted in the opening stories, the U.S. economy is looking pretty decent. Home prices are rising. Labor market looks good. Consumers are spending.
No, I was just going to ask, if the United States, in the form of Janet Yellen, the Federal Reserve, raise rates, was that due to the dollar and everybody in Europe? Did they say, uh-oh, there goes all that capital leaving Europe, going to the United States because rates are higher?
Well, I don't think that one or two rate increases will lead to that sort of dramatic capital outflow out of Europe. But this is something that Janet Yellen is very focused on. So the real moving part that I'll be watching is the dollar-euro exchange rate. Back in March...
Are you surprised that the euro is as strong as it is against the dollar?
Following this, right? I think there's some confidence that this will still be resolved, and that's why you're seeing that.
Why? Is that because it's really the Deutschmark and not the euro underneath all this?
I suppose so, and also that there are better buffers put in place through European quantitative easing. You're not seeing the blowout in the other periphery countries and whatnot. But back in March, Janet Yellen drove a stake through the heart of the strong dollar in her Fed press conference. She's very sensitive to the knock-on effect for the U.S. economy from that strong dollar, the impact on the export sector, as well as domestic producers. So she does not want to see a revving of the dollar due to the situation in Europe. So she'll proceed with that one rate increase if she's confident that there's not a broader tightening of financial conditions that's happening because credit spreads are blowing out, the dollar's getting stronger, or the equity market is swooning.
Although I still can't get my head around the fact that everybody says that Greece is priced into the euro when nobody knows what's going to happen. So, Carl, I guess my question is, what is the key symptom of contagion that Janet Yellen is looking out for? Is it a run-up in peripheral bond spreads in Europe like we used to see, you know, in 2011, a run-up in Spanish and Italian debt, or is it a move?
I think she's looking for even broader contagion across the Atlantic into the U.S. economy. So if you see corporate confidence faltering, that could presage a hiring soft patch. If you see, swoon in multinational corporation equity valuations. So if the stock market moves or if there's a big move in the currency, then that would be what would cause her to
So
pause.
If we suddenly see a big sell-off in European equities that have big exposure to Europe, that might make her nervous.
If that sell-off in equities is translating into the U.S. markets as well.